75%. I mean, that is just a massive number. But here's the multi-billion-dollar question we're looking at today. Can a legacy auto parts supplier, a company literally born at the dawn of the internal combustion engine, actually survive the heavy metal pivot to electric vehicles? And does the fact that 75% of its $4.5 billion new business backlog is dedicated strictly to EVs guarantee that survival?
Welcome to The Explainer. Today, we're putting on our professional sell-side equity analyst hats. We are going to conduct a rigorous, fully documented fundamental valuation teardown of Dana Incorporated. We're pulling data directly from their latest 10K, their preliminary 2025 results, and that highly anticipated March 2026 Capital Markets Day. We're going to deconstruct the whole thing, their core business, their competitive positioning, and man, those aggressive 2030 targets. Okay, let's dive right into this. Here's our roadmap. First, operations and segments. Then, we'll check out the competitors, explore the EV pivot, look at those 2030 financial targets, and finally, we'll build out a DCF valuation framework. Let's go.
All right, Section 1, Business Operations and Segments. So before we can even think about modeling out cash flows, we really have to understand exactly how this company makes its money today. Dana's roots actually go all the way back to 1904. But looking at their recent filings, their operations break down into 4 core segments. Light vehicle drive systems is by far the biggest piece of the pie, at over $4.2 billion. Then you have off-highway at about $2.7 billion, commercial vehicle at roughly $2 billion, and power technologies coming in at $1.29 billion. Now, why does this matter? Well, that massive legacy light vehicle segment, it is sitting right at the absolute epicenter of the EV disruption. It's the most vulnerable part of the business, and it's going to require the absolute most capital to transition. But wait, here's a totally critical update that was kind of buried in the recent footnotes. Dana actually just completed the sale of that off-highway business at a $2.7 billion enterprise value. I mean, this is a massive structural shift for them. The proceeds from this divestiture directly enabled a $1.9 billion debt reduction. That fundamentally alters their capital structure heading into 2026 and gives them some seriously much-needed breathing room.
Moving on to Section 2, the competitive landscape.
Now, to properly value Dana, we have to benchmark them against the rest of the auto components industry. And let's be frank, they are competing against absolute Goliaths here. Just look at the stark contrast in financial health. Dana has roughly $10 billion in scale, but historically, they've carried a highly leveraged balance sheet, often with a net debt to EBITDA ratio of over 3.0x. Plus, they're scraping by with incredibly thin 3 to 5% operating margins. Now, contrast that with Magna. Magna is a $40 billion behemoth. They have a fortress balance sheet and a net debt to EBITDA that's consistently below 1.0x. Or look at BorgWarner, easily pumping out 7 to 9% margins. Dana's thin margins, they leave practically zero room for error when they're faced with things like raw material inflation or, sudden production shutdowns.
It is a really tough neighborhood. But Dana's diversification does give them a slight edge over peers like, say, American Axle. If we do a direct, head-to-head comparison with a more similarly sized peer like them, you'll see they both struggle with thin margins and high debt. However, the filings show Dana holds a marginal advantage. Why? Because they have slightly better end-market diversification, specifically in commercial vehicles. American Axle, on the other hand, is heavily concentrated in the light truck space.
All right, Section 3, Navigating the EV Transition. Now we arrive at the core existential question for our valuation. How do they actually make the leap from internal combustion to battery electric? You got to remember, Dana doesn't do software. They don't do flashy infotainment screens. They do heavy metal. Their entire EV survival strategy relies heavily on 2 specific things. The e-axle, which is basically squishing the motor, inverter, and axle into one single unit, and thermal management. Because every single EV needs incredibly sophisticated cooling systems just to keep the battery safe and running efficiently. In fact, industry data cited right there in the filings projects the EV thermal management market is going to nearly triple by 2028. This is exactly where Dana is planting its flag.
But as analysts, we have to model the material risks, and these are explicitly listed right in the 10K risk factors. First up, sky-high customer concentration. Ford alone often accounts for 20 to 25% of their total revenue. Basically, if Ford sneezes, Dana catches a really bad cold. Second is the intense capital expenditure. It costs an absolute fortune to retool these massive factories for EVs. Third, those super thin legacy operating margins we just talked about. And finally, formidable competitors. Just look at the commercial space.
Cummins recently acquired Meritor to offer a fully bundled electric powertrain. Dana is offering unbundled parts, so they face a very real risk of just being designed completely out of future truck platforms by these integrated giants.
Let's pivot to Section 4, Dana's 2030 financial targets.
At their recent Capital Markets Day, management laid out their Dana 2030 plan. And honestly, reading through the management discussion and analysis, this plan is super aggressive. Here's the bridge they have to build. In their preliminary 2025 results, they reported roughly $7.5 billion in sales with an 8% adjusted EBITDA margin. But their 2030 targets? They're aiming for approximately $10 billion in annual sales and an adjusted EBITDA margin of 14 to 15%. I mean, think about that. That requires a 33% revenue bump and a staggering 400 basis point margin improvement in just 4 years. Management is claiming they're going to pull this off through higher margin new business and some serious structural cost actions, including a recent $325 million cost reduction program.
So the real question is, does management actually believe their own super aggressive projections? Well, it looks like they're putting real capital behind it. CFO Timothy Kraus literally said that the dividend increase and expanded share repurchase program underscore the board's confidence in Dana's strategy. I mean, hiking the dividend by 20% and expanding buybacks to a total of $2 billion by 2030, that is a massive signal of confidence they're sending straight to the market.
And finally, Section 5, the DCF valuation framework. Because as analysts, we don't just take management's word for it, right? We model the cash. So, here's how we build our unlevered free cash flow, or FCFF. This is literally the lifeblood of our valuation. It's like a puzzle. We start with EBIT, multiply that by 1 minus the tax rate, then we add back non-cash charges like depreciation and amortization. Next, we subtract capital expenditures, which, as we know, are going to be massive for this EV transition. And finally, we subtract changes in net working capital. Dana's 2030 plan targets an adjusted free cash flow margin of about 6%. Doing this step-by-step calculation is exactly how we test if that 6% target is even mathematically viable, given how capital-intensive they've historically been.
Now, because certain specific inputs, like exact forward effective tax rates or a super precise beta, weren't explicitly detailed in the event press releases, we absolutely have to declare some sensible defaults to calculate our weighted average cost of capital. For instance, we're assuming a standard market risk premium of 5 to 6%. For the capital structure, we assume target leverage is going to drop below 3.0x, and we can justify that because of that massive $1.9 billion debt reduction from the off-highway sale we mentioned earlier. And for terminal growth, we're using 2 to 2.5%, which perfectly aligns with long-term GDP and mature auto industry growth rates. So we've extracted the core products, we've analyzed the absolute fierce competition out there, and we've built a framework to test those incredibly ambitious $10 billion, 15% margin targets. So I want to leave you with this final thought as you go and plug these variables into your own models. With the immense execution risks of this heavy metal EV pivot, is Dana's 2030 vision already fully priced in by the market, or is this highly leveraged supplier actually a deep value trap? Well, the math is in your hands. Thanks for joining this explainer, and keep digging into those filings.